This ETF arrived dressed like an income machine and left investors holding a disappearing asset. The cash was real. The yield display was spectacular. But the account balance tells a much darker story. Much of what looked like income was the investor's own capital making a slow, taxable-looking walk back across the table. Today, we are not asking how big the payout was. We are asking what survived after the payout. Today, we're dissecting the Defiance-leveraged long-income MSTR ETF, ticker MST, as of July 17, 2026. This is not a conventional dividend fund. It does not collect rent from a diversified portfolio of durable businesses and pass the profits along. It is an actively managed trading vehicle built around the daily movement of one extremely volatile company. It seeks leveraged exposure to that company through derivatives, then layers an options income program on top. Picture a race car pulling a concession trailer. The leverage is trying to make the vehicle move faster in the same daily direction as the underlying shares. The options strategy is selling something along the route to generate cash. Those two jobs can coexist, but they do not magically cancel each other's risks. The leverage magnifies a difficult path. The income overlay turns some market opportunity into immediate distributions. And if the underlying asset falls hard enough, no amount of cash handed out along the way can preserve the original vehicle. That distinction is the entire case. A distribution can feel like profit while the fund paying it is shrinking beneath you. So we will separate the cash flow from the investment result, examine the payout history, follow the net asset value, and then open the hood on the swaps and calls that power the machine. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value, including funds designed to produce income. Verify the current prospectus, holdings, distribution notices, tax information, and other fund documents directly with the issuer, and consult a qualified professional about your own circumstances before making any decision. Let's check the vitals. The fund launched on May 1, 2025. It pays weekly, charges a 1% expense ratio, and has $13 million in assets under management. Its category is trading miscellaneous, which is a useful warning label in plain clothes. This is an equity ETF, but it behaves more like a specialized trading instrument than a broad long-term stock portfolio. The weekly schedule matters psychologically. Frequent deposits create a powerful sense of progress. Every payment is visible. Every X-distribution event feels like the strategy doing its job. But frequency says nothing about durability. A cashier handing you smaller pieces of your own wallet every week is still handing you cash. The calendar cannot tell you where the money came from. The fee is not the main cause of the damage in this case. The underlying path and strategy structure matter far more. Still, it is another hurdle for an unusually demanding job involving trading friction, financing effects, and option outcomes. Now for the number designed to stop the scroll. The headline distribution yield is 1,149%. That figure is not a promise of what a new buyer will earn over the next year. It is a rear-view calculation built from distributions and a severely reduced share value. When the denominator collapses, a trailing yield can explode even if the actual cash payment has collapsed too. The screen flashes abundance while the payment stream is telling a different story. The latest distribution was 9 cents per share. Annualizing that latest payment mechanically produces 56%. That is still enormous by ordinary income standards, but it is nowhere near the headline display. More important, even the mechanical rate is only a snapshot. It assumes the latest payment continues on schedule. The fund has not earned the right to that assumption merely because a calculator can multiply one payment across a calendar. This is why yield on screen and yield in your life are different measurements. The screen asks, how much cash was associated with this recently? The investor needs to ask, how much value did I have to lose to receive it, and is the current payment repeatable? A giant quoted yield attached to a collapsing asset is not automatically a bargain. Sometimes it is simply the mathematical smoke rising from the wreckage. Time for the history, because one payment can flatter almost any story. The first 4 distributions averaged 807 cents per share. The latest 4 averaged 8 cents. In other words, the recent average is 1% of the launch period average. That is not ordinary week-to-week noise. It is a payout structure that has radically reset downward. Early buyers may have experienced the opening payments as confirmation that the strategy was working exactly as advertised. But launch period payouts are a dangerous foundation for expectations. A new leveraged options fund can begin with a very different share value, volatility backdrop, and capital base than the diminished vehicle that exists later. Extrapolating the first checks is like judging a reservoir by the water released when the gates first open. The flow can look tremendous while the level behind the wall is falling. The direction of travel also changes how we interpret the current payment. A small weekly check following much larger checks is not evidence of stability merely because it arrived on time. Consistency of schedule is not consistency of economic power. The relevant question is whether the fund can generate future distributable cash without continuing to consume the base that supports the strategy. Now we reach the body of evidence, the price and NAV path. The launch reference price was $574.82. The latest NAV and price were $8.16. The NAV return since inception was negative 99%, and the maximum drawdown was also negative 99%. Net asset value is the per-share value of what the fund owns after liabilities. NAV is not a side statistic competing with the distribution. It is the reservoir from which the strategy must continue operating. When that reservoir is almost emptied, the fact that water was carried out in buckets does not make the system healthy. A decline this severe also changes the practical meaning of recovery. Percentage losses and percentage gains are asymmetric. After a deep collapse, an impressive rally can still leave the holder far below the starting line. Leveraged daily exposure makes the journey especially path-dependent. A sequence of down days, followed by up days, is not economically identical to a smooth trip between the same endpoints. Daily resetting means the fund repeatedly applies exposure to a changing capital base, so volatility itself can become destructive. That helps explain why merely being bullish on the underlying company is not enough. A holder can eventually be right about the company's direction and still choose a vehicle whose route, resets, fees, distributions, and option outcomes produce a much worse experience than expected. Thesis and instrument are separate decisions. This instrument demanded that both be right. Cash distributions since launch totaled $164.92 per share. Put that cash beside the remaining share value, and the simple distribution-inclusive return since inception was negative 70%. This is the accounting moment that cuts through the theater. Total return asks what happened to the whole investment. Price change plus cash received. It does not insult the distributions or pretend they never arrived. It gives them full credit. And even after giving them full credit, the result remained devastating. That is why "I already got paid" is not a complete defense. If an investor begins with a valuable claim, receives portions of value as cash, and ends with a much smaller claim, the cash may be economically closer to liquidation proceeds than to wealth creation. The label on the transaction does not determine whether the investor became richer. Taxes can make the personal result more complicated, and the documents must be checked for the actual character of each distribution. But the investment lesson does not require a tax opinion. Cash flow and profit are not synonyms. Spendable cash can arrive during capital destruction. Reinvested cash can buy into continued decay. Only the combined result reveals whether the strategy added wealth or rearranged it. A plain position in the underlying shares would carry enormous company-specific risk, but at least its purpose would be direct: participate in the share movement. This fund added daily leverage, derivatives, an income overlay, fees, and distribution policy. Each layer must justify itself. Here, the final combined score shows that complexity did not protect capital. Here is the machine under the hood. The official objective is 1.5 times to 2 times leveraged exposure to the daily share price movement of MicroStrategy Incorporated, less fees and expenses. There is no index. Instead of simply holding a conventional stock basket, the portfolio shows Strategy Inc. Swap Cantor at 53%, Strategy Inc. Swap Merx at 52%, and Strategy Inc. Swap CS at 49%. It also shows US dollars at 37%, United States Treasury bills at 29%, and Dreyfus Government Cash Management Fund, DGCXX, at 2%, plus 2 call options, the fund writes for premium income. The swaps are contracts with counterparties. They let the fund receive the economic effect of the target share movement without owning an equivalent pile of shares directly. The cash, treasury bills, and government cash fund can serve as liquid collateral and portfolio plumbing around those contracts. The percentages do not read like a normal portfolio that must add neatly to a familiar stock allocation, because derivative exposure and collateral are different layers of the same structure. The daily leverage is the accelerator. If the target shares rise during a day, the fund seeks a magnified positive move before costs. If they fall, it seeks a magnified negative move. Then the exposure resets for the next day. In a sustained favorable trend, that can produce powerful upside. In a violent, choppy, or falling market, compounding can punish the fund even when the underlying later rebounds. The income engine is the credit call spread program. In general, a call credit spread sells call exposure and pairs it with offsetting call exposure farther away, collecting a net premium while limiting part of the option risk. The reported portfolio specifically shows written calls. That premium is real cash, and high volatility can make option premium look especially rich. But premium is compensation for surrendering something. What should an investor watch from here? First, compare each new distribution with the direction of NAV. A payment accompanied by a healthier capital base is very different from a payment carved from continued decline. Second, read the fund's current distribution notices and tax documents. Identify how much is attributed to option activity, income, gains, or return of capital. Do not treat the word distribution as a source label. Third, monitor whether the recent payout level stabilizes or keeps stepping down. The launch checks are no longer a useful income budget. The relevant evidence is what the present portfolio can support. Fourth, examine the current holdings and prospectus for changes in swap counterparties, collateral, option construction, leverage targets, or distribution policy. Active management means the machine can change, and yesterday's anatomy may not describe tomorrow's exposure. Fifth, compare the fund against the simplest alternative that expresses the actual thesis. If the goal is participation in the underlying company, ask what each extra layer contributes. If the goal is dependable income, ask whether a single company leveraged derivative vehicle belongs in that job description at all. Finally, watch liquidity and fund viability. Assets under management, spreads, trading volume, and issuer communications can affect the experience even before the investment thesis is considered. The right question is not, can the yield stay huge? It is, can this structure preserve enough productive capital to make future payments economically meaningful? Cause of death, NAV erosion. The assigned verdict is blunt because the evidence is blunt. This fund distributed a large amount of cash, but the holder still suffered a severe loss after every payment was counted. The payout collapsed from its launch period pace, while the asset supporting that payout was almost wiped out. Economically, the distribution was largely the holder's own capital coming back. There may be traders who deliberately want a short horizon, leveraged, option-shaped exposure and understand the daily reset, the capped recovery paths, and the possibility of rapid capital loss. That is a trading use case, not a clean income thesis for an everyday investor seeking durable cash flow. The lesson is bigger than this patient. Never diagnose an income ETF by its yield alone. Trace the money from the strategy, through the distribution, back to NAV, and finally into total return. A fund has not created income wealth merely because it moved cash into your account. The autopsy question is always the same. After the checks cleared, what was left alive? 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.